Hi, I'm Bonnie from the Saskatchewan Pension Plan. Thank you for joining us for the second in our two-part series on bonds. Today we are going to discuss the risks associated with investing in bonds. Some of the risks associated with bonds include default, prepayment, and interest rate risk. Default risk is the risk that interest and principal payments due on the obligation will not be paid. Bonds are rated based on the ability of the issuer to repay the loan. Bond rating agencies provide ratings between AAA and D, and like a report card, financially secure companies will have a high rating, while risky companies will rate low. SPP's investment policy requires an initial rating of BBB or better for its portfolio. Prepayment risk is the risk that the bond issue will be paid off earlier than expected. Interest rate risk is the risk that changes in the interest rate will reduce the market value of the bond. If interest rates decline significantly, the investor faces the possibility of prepayment. If interest rates increase sharply, the value of the bond drops and the investors are more inclined to buy securities that offer a higher rate. The greater the time to maturity, the greater the interest rate risk an investor bears, because it is harder to predict market developments farther out into the future. On the risk-reward continuum, bonds are considered safer than equities, but as you have heard, they are not risk-free. A balance of bonds and equities, along with other investment types, is prudent when building a retirement portfolio. Thanks so much for joining us again for our series on investment basics.